Now you really want to look in for this one, ladies and gentlemen. We have another interview by CNBC with Tom Lee. Well, let's hear what he has to say about the current state of the market, the current state of the geopolitical scene, and where we're headed. I was warning about everything that we're seeing right now playing out exactly as is. And remember, and I want to remind you that Tom Lee has called bottom on the previous 6,300, and from here on out it's basically an upside case. So let's watch what he has to say, and then let's analyze the markets objectively, data-driven analysis, and not our gut feelings or opinions. Let's get straight into this.
Tom Lee, let's get back to the markets. Obviously, a lot going on outside of the markets, but the market itself does seem to be kind of looking past the war in Iran, looking past any political event. What is the market the most closely looking at right now?
Well, I think the market at the start of this year maybe had three risks it had to get comfortable with. One is Iran and a war, potential escalation. A second was private credit. And the third is a new Fed chair. And what we've seen, I think, is that we've come out the other side of this Iran war with the economy showing remarkable strength. In fact, earnings estimates have been going up. So I think we passed that test. And I think the underwriting for the private credit looks better than expected. I think that's why IGB is rebounding. And so I think the upside...
What is IGB?
Oh, sorry, the software ETF.
Okay.
Because that fell all the way down to 72. It's back to 85. And so a lot of private credit loans were tied to software. I think that is looking less of a structural problem. And so to me, this means, I think for stocks for the year, the upside case is strengthening. I think S&P above 7,700 is very probable.
What other are the kind of planks that feed into or build into that?
Well, I think one is earnings estimates are higher. And now we're seeing AI, I think, deliver productivity. And, earlier on CBC, Torsten was talking about how there is the positive case for AI, which is, business growth and company formation. And I think risk premia later this year drops because if we settle the issue in the Middle East, you're taking out, hostile oil premium that's been priced in oil for a long time. So I think that allows markets to lift higher.
Oil is still at $95. I think I tweeted out this morning that the market was kind of in the settle-in mode. I think that oil hasn't moved really in a week or two. We're kind of now in this sort of stasis, if you will, with regards to that, because I think you said on this program a couple of weeks ago that the war was the most important thing in the short term. What are the two possible outcomes for the markets vis-a-vis Iran? Best case, worst case?
Yeah, and these are pretty big.
Yes, they are.
It's on two very far sides. I think one is an extended war, and therefore it's a mirage that oil prices are low because now we're going to have a drawdown in inventory and lost production. And so I think price for all petroleum products jumps dramatically, and then that puts a lot of global growth at risk. The other side is the war is resolved quickly, and that's through all the combination of pressures. I think the market is betting on a shorter war at the moment.
So a lot of the times, the recent years, we've talked about stocks and bonds, but the strong performance of commodities has Michael Hartnett, Bank of America's chief investment strategist, saying a better portfolio positioning right now would be what he calls the sleep like a baby portfolio. He says it's an equal weight allocation across stocks, bonds, cash, and commodities. According to Hartnett, this four-way split is having its best year since 1933 and delivering one of its largest relative wins ever versus the traditional 60-40. Now, we all know every strategy can have a good year. It's like a broken clock, right? But is this a working clock that people should think about this kind of allocation and sticking with it?
I mean, there's a lot of logic to that because, one, we know that gold's been a really good total return performer. And so I think gold should sit in portfolios, which probably sits in commodities along with crypto. And then I did hear someone earlier this year point out NASDAQ and oil are actually good counter hedges. So yes, in some ways, at 25, that portfolio does make a lot of sense.
In fact, technology and energy have kind of been these two sides of a balance. You'll have a decade where energy does really well and then a decade where technology does really well back and forth. And what's interesting right now is that both of them are kind of doing well. And maybe your point is you don't have to pick, just own a little bit of all of them.
AI is pulling both of those together anyways,
Exactly,
right?
exactly. And kind of changing a little bit. We spoke with Roger McNamee last hour. He expressed some concerns about what's happening with these AI models because the OpenAI in particular doesn't have the revenue to justify its CapEx right now. And we're about to go into tech earnings where all the focus is going to be on CapEx. Do you have any concerns that there isn't going to be a pot of gold at the end of this CapEx rainbow?
Yeah, I mean, it could play out several ways. Of course, there could be some breakthrough where power consumption drops. But as you know, we are consuming every piece of compute. So to me, it does seem too early to worry about that as well.
All right, so now that you heard Tom Lee's opinion about where oil is or where it's headed, we're going to look at the objective technical analysis that has no opinions. It just simply shows us where the momentum is headed, right? So as we can see, and you can now use the new overlay I have right here set up just for you guys. Look right above me, you will see how you can read the stochastic RSI, stochastic strength, relative strength index indicator, that we are using as a speedometer of sorts to read the momentum and the directionality for the current price action. So as you can see, we have become more so. First of all, we are objective right now in neutral zone, so we have never gone bearish objectively. That's why we have generated, as you can objectively see, a higher low, basically a low point that is higher than the previous low point. So pretty simple, starting to show a structural gradual build up to the upside rather than downwards. Pretty simple. It's pretty evident, so you can see that on the chart. Of course, as you can see on my chart, I was showing how we're gonna have that sort of price action play out. Of course, I was not trying to hit perfect spots, but rather to highlight the overall theme of things. And as you can see, we are now objectively bullish. Our momentum has flipped over. Our K is dominant, and so we are now objectively our shorter or faster moving average, which what K is basically represents, end up representing how our momentum currently playing out. Our momentum currently is more so bullish, and so we're seeing more of a build up to the upside, given how we already are at $100, revolving around $100, which means the handles of 90 and above the 100. So, but that is what we're seeing on the 6 months. So what is the shorter range sort of narrative? The shorter range narrative, as you can see right here, is that we are about to cross that median, that center range at 50. And so the directionality objectively, as the divergence is larger and pointing to the upside, that means we are seeing more upside in the energy sector. As Tom Lee correctly now tried to explain, although partially, at the end of the day, petroleum byproducts are, as they're all affected, and everything, all the derivative products from oil will affect inflation, will affect the bottom line of all the companies, will affect how much we pay from the grocery store to the pump to, you know, our day-to-day non-discretionary spending, that sort of stuff, including our discretionary spending. Everything, of course, will be highly affected, basically. And as you can imagine, we are about to see higher prices, not including how high they already are. Now, as we are seeing, this is not a call for $150 a barrel prices, not yet at all. If we're looking at the monthly, we are moving towards convergence, towards confluence, a crossover of the forces, when we become a little bit more bearish. And as you can see, again, the highlight of this is not necessarily to show that this is exactly precisely the amount or the structure of the waves we're going to have. It is a general guideline. Now, as you can see, there is this blue and red channel, right, which is our linear regression channel that is generated via the price action itself. So it's nothing arbitrary that we decide where it goes. The price action itself dictates where that bottom and upper range are, and of course subsequently the median. And so as we can see, we have a clear uptrend right here still on the monthly. On the weekly, we have a bit of a different story. On the weekly, we are moving into correction territory. We are below the 50, we are bearish dominant, and we are moving, although towards some confluence right there, so convergence, divergence, all the forces. Right now we are objectively bearish, in bearish territory. Thus that means we are about to see more so downwards pressure. All in all, you got to understand that we are simply revolving around these two main levels, that 99.59, 95.08. Of course, there are several very important adjacent levels such as 87, 78, 118, and so those function as the support and resistances for that wider range that we are revolving around. And so yes, we are about to see now more downwards pressure that may lead for us to see 87, which we know it has some partial weaker role. 78, 96, basically the ranges of 80 and a little bit lower. People may celebrate that and think that's it, everything is resolved and we're going, you know, for a major correction downwards, and oil prices will drop and everything will be fine. Well, not so quick. we still have that upwards pressure on our daily, and so within the following sessions, if anything, we're about to see more upside pressure. It appears to be retesting that median range that we have on the daily chart. Of course, it itself is developed out of the price action and how it's structured, and so that is the most objective support slash resistance level for that time frame. You got to understand these things are related and work in tandem. And so right now we're, although testing that 99.59 and 95.08, still irregardless we will see that ascending channel or its median range play a role and a function. Although on the grand scheme of things, as we said, even though we will be seeing a little bit more of upside and retest of the current levels, as you can see on all the channels, these points that are slightly above that 99, basically within the $100 range, are currently active. And irregardless of that, we got to remember that there still is a measure of correction and pressure to the downside that will occur, and so there is some rebalancing act in the market. As we know, the market is not linear, and so it will be a process of up and down before we conquer any newer highs. So that is with regards to oil. As we understand, there is a tight-knit relationship between oil, energy, and the broader market, the major indices. Of course, we can look at the 1 minute right now, wrong chart. We can look at the 1 minute right now and see, and everybody's of course maybe panicking, saying, oh, the price action has dropped again. Of course, as you can see, the levels I have warned and spoken about and shown before, that 7,134 playing a role again. We cannot pass through, very rarely that we pass through some of these levels without showing the retest basically of these levels again and again, the respect of these levels, the confirmation, the objective confirmation of the market being very well aware of these levels. But realistically speaking, we're simply at the bottom of the channel right now, and as we know, it's very unlikely for the market to leave these gaps alone. And although I keep on highlighting and reminding everyone how gaps themselves are more of a side effect, and irregardless, they still are very important. And within the shorter time frames, they do play some magnetic range that does end up attracting the various robotic and the shorter range traders that are attracted to the probability of these gaps getting closed, and so subsequently yielding very quick returns. And so it's not going to be all that far-fetched for us to see, although right now this is what we're seeing, and we're roughly about an hour before market open. We're still probably about to see right now, as I'm recording this, it's 3:25 p.m. over here at Israel, so basically about an hour before the US market opens. So that's why we're looking at the futures contract. We're looking sort of a little bit ahead. And so if we look at the 5 minutes, we're going to see the picture change a little bit. And yes, we are basically seeing a movement from the top of the channel to the bottom of the channel on the shorter range movement. Oh, Greg, look, we slipped out of the channel. Yes, that doesn't mean anything. We may slip back and retest it. Irregardless, what you will see playing a more major role are the larger width channels, the channels that are longer duration. We are even slipped out of that one right now when we're retesting that 7,134, as you can see on the screen. Some people ask, Greg, why don't you have all the support and resistance levels in this vicinity as you usually do? Because they are unimportant. We're going to leave them very shortly. We're going to retrace back down to all the very well-known support and resistance levels. This is an extreme that was generated out of the current circumstances, and on the technical side of things does not pose a pattern-breaking scenario. It is not great, very unlikely, and yet it is plausible and kind of normal within the general framework of things. Again, not very common, but still is possible. So as we're seeing it playing out, it does not cancel out the overall broader picture, which still does indicate severely for a downtrend. Of course, right now we're going through some level of entanglement, given how that 45 minutes still plays a role within the shorter range of the price action before the actual open market hours come about. So right now we're still kind of testing and moving within the framework of the pre-market. Once these levels get more stabilized, closer again to that 1 hour range, potentially filling in the gap that will be generated. Because why gap? Because we have closed roughly at around 7,173, which means we're more likely than not to either rally to that point as the market opens, or move towards it gradually, or even rally towards it before the market opens, and so we will open up around that range, leading to a filling of the gap to the downside. Again, sort of per se saying no actual gap, but actual price action that was led back into the close point, and so led back down given the momentum that was spent, right? The reality is that both scenarios can play out, and it doesn't matter which one. In fact, again, as I've said and highlighted multiple times before, gaps are a side effect and so are not as important as people are misled to think, and can be left alone for literally years until they are filled. Objectively, right now, what we are seeing is the price action leading a little bit more downwards, but within the grand scheme of the framework, we still understand that it's far more likely for it to correct to the upside before or as the market opens, and only then continue the downwards pressure as we're seeing it is being built up. And I warned about this multiple days ahead of time. Unlucky for me, yesterday I was very busy with multiple errands and personal life emergencies. And even though that we still had an academy meeting with my members, which I highly recommend you all should join my community and Discord right away while it is still discounted. That $10 basic tier, which grants you basic access to the Discord, on which I post on the daily basis. We discuss various topics. It's from the broader market or individual assets. For example, right now you can see one of the discussions at hand was the asset named Plug Power. It is, of course, is related to the energy sector. It is a hydrogen based company. They generate hydrogen themselves, green, blue hydrogen, and it's just a very interesting company that appears to have very good future, just at least on the technical side of things. Of course, there are many chat rooms and discussions, including the Academy, which belongs to the Academy members, the graduates who graduated the Academy. I highly recommend joining in because the Academy is also still highly discounted. You do not join the Academy this way, you join the Discord, and of course on the Discord we have a Q&A. You and I discuss a little bit about the Academy. You ask your questions, I answer your questions, and so we then decide if it's the right path for you, both of us, because yes, I don't just take upon anyone onto this Academy. Now, of course, you have the full access, which you still is, by the way, discounted. It's going to go higher in price and going to be $100. Not that substantial, but yes, you can make it cheaper by making it $72 instead of that $90 right now, paying annually. I highly recommend you all join because my community members are highly informed and fully aware of what's going on and are not misled by various talking heads like Tom Lee, who are basically saying almost the things that are misleading the current average Joe, if you will, the average participant of the market, to make grand mistakes that are going to lead to loss of generational wealth and the loss of opportunity to generate said generational wealth as well. So that's it, ladies and gents. I hope you enjoyed this one. Don't forget to ring the notification bell. Don't forget to like and subscribe. Join the community, otherwise you'll be misinformed like the rest of the people around, and you'll not be aware, and you'll be caught off guard with your pants down when such events like what we're seeing right now playing out in the market, and you will be very upset that you were not prepared, nor do you understand and have nothing to anchor your logic to and understand what the price action is trying to imply or do. That's it, ladies and gents. I'll see you in the community. I'll see you on the next one. Don't forget, I have warned all about this far in advance. And yeah, it's a shame that most people just don't want to hear. Instead, you can become wiser and become your own independent analyst. See you on the next one. Bye-bye.